Welcome back to What's Hot and What's Not in CRE, your daily pulse on commercial real estate in America. I'm your host, Rachel. Today we're talking interest rates, specifically what the 10-year Treasury is doing and what it means for CRE financing heading into 2026. Let's get into it. First up, what's hot? Well, believe it or not, a dose of stability. Remember the anxiety when the 10-year Treasury peaked at 4.79% back in January 2025? Well, the consensus now is that we're settling into a more predictable 4.2 to 4.5% range through 2026. No, it's not cheap money, but it's predictable. And predictability is exactly what dealmakers have been desperate for. Also hot, slow and steady Fed easing. The market is pricing in 2 to 3 cuts in 2025, with another 2 to 3 expected in 2026. This isn't a dramatic pivot. It's a gentle glide path, aiming to bring the Fed funds rate down to around 3.0 to 3.5% over the next year or so. It feels like a genuine soft landing. Next, spreads are tight. For the right deals, that is. Credit markets are rewarding quality. If you're a well-capitalized borrower with a prime asset, you're seeing spreads compress. This is a significant tailwind if you're refinancing a stabilized property. And all this leads to our final hot item, underwriting clarity. For the first time in a while, sponsors and lenders can model deals with confidence. The new playbook is straightforward. Base your case on a 10-year around 4.25 to 4.5% and run your stress test at 5%. That's the new discipline. Now, let's pivot to what's not so hot. Number 1. We are not returning to the low-rate world of the 2010s. The era of sub-3% long-term yields is over. Structural factors, large fiscal deficits, a heavy supply of treasuries, and sticky inflation are keeping yields elevated for the foreseeable future. This means higher financing costs are the new normal. All-in coupons for core stabilized assets are consistently in the 5.5 to 6.5% range. For transitional and value-add deals, you're looking at 6.5 to 8% or even higher. That's a permanent 150 to 250 basis point increase from pre-pandemic levels. That changes the math on everything. Because of that, cap rates won't be compressing anytime soon. With the 10-year Treasury firmly in the mid-4s, there's simply no pressure for cap rates to go down. The bias is flat to slightly higher. Your exit assumptions absolutely must reflect this reality. Finally, refinancing risk remains elevated for a specific cohort of properties. Any asset purchased at a 3 or 4% cap rate with floating rate debt originated between 2020 and 2022 is still in a precarious position. Lenders are demanding lower LTVs, more amortization, and much tighter covenants. The refi cliff is still very real for some. So that's your interest rate update. The bottom line is this. Rates are finding a stable, predictable range, but the higher for longer regime is here to stay. Underwrite accordingly. Thanks for tuning in. See you tomorrow.